So on behalf of Transurban, I'm pleased to introduce the final and what we hope to be the most exciting panel at the P3 2019 conference. And it's not just because I'm going to take my seat over there. Innovative financing models are truly one of the most important areas of innovation in the infrastructure sector. Creating financing structures that can attract institutional investors, government lenders like TIFIA and the Canadian Infrastructure Bank, and private equity providers enables major infrastructure projects to come successfully to market, especially when governments around the globe are struggling to build due to limited public funding. Transurban is one of the world's largest toll road operators. We operate 14 motorways in Australia and 3 in North America, in addition to the A25 in Montreal, which we just acquired about 18 months ago. We design our roads for the long term, ensuring they'll deliver real and lasting benefits to cities and their communities. We're also a technology company that researches and develops innovative tolling and transport solutions that makes travel easier for everyone. Today we have experts in the innovative financing field joining us from the Canada Infrastructure Bank, the Canada Pension Plan Investment Board, and the European Bank for Reconstruction and Development. Keeping the panel on point as our moderator will be Vickie Turnbull, Managing Director and Co-Head of Infrastructure Finance Canada at RBC Capital Markets. Vickie, who you might have noticed at lunchtime today, is this year's recipient of the Outstanding Leader Award from the Women in Infrastructure Network. We're really happy to have her here today. She's a highly respected expert in infrastructure finance, ranging from debt structuring to loan syndications and corporate debt structuring. She's also been the hands-on lead financial advisor and/or debt provider for the winning consortiums for more than 25 infrastructure projects in Canada since 2005, and she's been involved in more than 60 bids. So please join me in welcoming Vickie and the rest of our panel. Thank you.
Thank you, Mike. I have the great pleasure of moderating this fabulous panel on innovative financing models for major transportation projects. I'd like to introduce you to our panelists today. And after I've gone through and named each of them, I'm going to ask them to actually give their brief little bio and why they're here on this panel. So to my immediate left is Pierre Lavallée, President and CEO of the Canada Infrastructure Bank. To Pierre's left is Andrew Hay, Senior Principal, Infrastructure, Canada Pension Plan Investment Board. To Andrew's left is Matthew Jordan Tank. He's the Director of Sustainable Infrastructure Policy and Project Preparation for the European Bank for Reconstruction and Development. And at the end, we've got Mike Discenza, who's the CFO for Transurban North America. Pierre, could I turn it over to you to give a bit of a brief bio?
Sure. Just before joining the Canada Infrastructure Bank in June of 2018, I was over with Andrew, just a few blocks down the street at Canada Pension Plan Investment Board, where I was Senior Managing Director and Global Head of Investment Partnerships. I heard that word used a lot in the last panel, and that's where I spent a lot of my time, frankly, mostly focused on investment partnerships outside of Canada. And of course, in taking this role a little over a year ago, I've been able to refocus back on home issues a little bit more.
Thanks, Pierre. My name is Andrew Hay. I work at Canada Pension Plan Investment Board. We're a company that administers a single pool of capital that is currently valued at $410 billion, and it's looking to grow to an incredible $1 trillion by the mid-2030s on account of net contributions that will occur between now and then. I work in the infrastructure group. When I started in 2006, the infrastructure group had $1 billion of equity committed to the space, and we now have at least $35 billion and up to $50 billion, depending on how you aggregate infrastructure with renewables and other energy investments.
Okay. Good afternoon. Matthew Jordan Tank from EBRD. I'm based in London, UK. So I came to the EBRD 12 years ago now, having spent a previous 8 years at the Inter-American Development Bank. I'm a transport planner by background, so this whole topic is near and dear to my heart. We do about 10 billion euros of annual investments, half of which is infrastructure, where I work in the banking team. I'm in charge of all the project preparation, a large team of engineers, policy experts, transaction advisors, including PPP pipeline development for governments. So really happy to be here to share some of our experience with you.
And I'm Mike Discenza, Thanks, I'll take that. CFO for North America for Transurban. I've been with Transurban a little more than 3 years, and most of my career, really all my career, 25 years, has been in the project finance space, developing infrastructure either for developers or investment funds, or on the lending side from various financial institutions and bond guarantors. And I also, early in my career, spent some time in the US government, both in the White House Budget Office, OMB, and as CFO of the US Export-Import Bank. So I have a pretty good sense of how both sides of the public-private partnership model works when you do infrastructure. So happy to be here.
Great. Well, we've got some prepared questions, but obviously if there are questions that you have burning in your head that you absolutely need to have answered before the conference is over and you head to the bar, please feel free to submit them. I know.
You shouldn't have mentioned the bar.
Well, but most people will be surprised that I'm actually here and not at the bar.
That means it's not
This is
open
pretty
yet.
good turnout for the
That's
last.
exactly what it means. Thanks, Pierre. But so we'll go through some of these, but if you've got some questions, please feel free to submit them through the app. So Pierre, the Réseau Express Métropolitain, the REM project as we affectionately call it here in Canada, was CIB's first investment. Help us understand, how did the CIB investment improve the project, and would the project not have gone forward without CIB involvement?
So thanks. Love to talk about our first investment. We recently celebrated the first anniversary of the closing of the investment, and the REM is 67 kilometers, 26 stations of new urban transit infrastructure in Montreal. We invested a $1.28 billion in a 15-year loan in the project, which in of itself is dramatically different than what would have happened had the bank not existed, right? In the traditional model, the federal government's contribution would have been a grant. It would have been handed over to another level of government, and then they hope that the project actually takes place. In this case, the Caisse de dépôt, I think setting an example for other institutional investors, actually came forward with a $2.9 billion equity commitment to the project. And when paired together with equity contribution from the government of Quebec and our loan at $1.28 billion, you have a package that actually looks very different from the way that traditional financing would have happened for such an important project. So far, it's working really well. You can literally see it coming out of the ground. I was doing some site visits recently, and it's just really exciting. Actually, this is the one thing I follow on Twitter every day. I get a few pictures of what's going on. I invite you to do the same. The cranes are incredible. It's really exciting to see it come together, not just because it can be a fantastic system for citizens of Montreal and the greater area around Montreal, but because I think it actually is a great example of what we can do differently and how much more capital can come into infrastructure, how much more of an opportunity there will be for private and institutional capital in the country. What we haven't talked about as much, I guess, but is an important point, is that 15 years from now, we expect to get refinanced out of that project with private capital. Again, very different than what would have happened normally.
To be clear here, Pierre, it'll be more than 15 years. I'm already working on it. This is for Mike and Pierre.
It'll be 50.
With the evolution of the CIB in Canada over the last few years, there's been some chatter that the CIB's involvement in Canadian projects will be TIFIA-like, or that it will look to emulate TIFIA in certain respects. I think we can all acknowledge that TIFIA has been a good source of financing in the US to date, but we often hear comments about the rigidity of the TIFIA loan process. Mike, perhaps we can get you to speak to some of the challenges with the TIFIA loan process that you have encountered and, quite frankly, would like to see more flexibility on. And then, Pierre, perhaps you can sort of add to that and talk about the fact that obviously the CIB has studied the TIFIA process in detail and are aware of some of its shortcomings, actual or perceived, and to what extent the CIB is working on flexibility to incorporate into its funding process.
There's a lot there. TIFIA is a cornerstone lender in both of our original projects in Virginia, the I-95 Express Lanes and the Capital Beltway project. So, it was very important. It was a very critical part of the financing structure to have TIFIA in those projects, and they are partners. In my time at Transurban, which, as I said, has been a little more than 3 years, when I walked in the door, one of the first things I had to finance was the I-395 extension of our 95 Express Lanes project. which actually just opened 2 days ago. So another P3 out there in the world. We're pretty excited. But TIFIA, we thought it would be pretty easy to just go to them and say, look, you guys are already in this credit, and it's an extension of an operating asset. We actually delivered a credit upgrade from BBB minus to BBB flat, and we thought it would be pretty easy for them to get their hands around that. And after many, many months of what we felt like were moving goalposts on the credit underwriting standards and an uncertain timeline to get to a definitive answer, we ultimately just said, it's just, life's too short. We have to get to the end. And we did a private activity bond financing instead. So it wasn't for lack of trying. We were very frustrated with that. But again, we had another opportunity to go back to them on a project that we just financed this summer, which is the Fredericksburg extension of our I-95 express lanes, which is the southern extension, now another 10-mile, $500-ish million project. So very similar to 395. Again, TIFIA is already a lender to the 95 core asset. We thought it would be pretty easy. We had just spent the better part of a year negotiating with them unsuccessfully on 395, and we thought we would be able to get there on the Fredericksburg project. Again, it felt a little bit like Groundhog Day, if you know the reference. We just couldn't get there. It was, you almost get to the end and almost get to the end, and look, we as a developer have to put up letters of credit to hit financial close by a date certain. And at some point, we just had to do the same thing we did on 395, which was go to the bond market, which is highly liquid, very predictable, very transparent, and it was kind of a pretty stark alternative to the frustrating TIFIA process. So we couldn't get to the end with them and went to the bond market. So that's the most recent experience with TIFIA. It's a complicated relationship because they have a huge amount of exposure to us, and we're thankful for that. But we were a little frustrated that we couldn't find a way to add to that exposure. So we're very excited about the idea of the Canada Infrastructure Bank. We've had some initial conversations with Pierre and his team about what those lessons from TIFIA might be, and to apply some of those lessons learned in Canada. And since we're now in Quebec, I'm very excited about trying to find a way to work with this alternative source of funding. So,
and I think if I had to picking up on that, if I had to characterize how we react to that example or other examples around the world, I'd wrap it around this concept of flexibility. We've been given an unbelievable privilege to deploy $35 billion of capital over a decade, and to actually be able to do that on a concessional basis, not just in terms of the rates that we charge or the expected return for our investment, but we have the flexibility to inject our capital where it makes sense the most for each individual project. So across, from equity up to senior debt, where it makes the most sense for each specific project, as opposed to having a template that we try to replicate 20 times. And I think that's the big difference. And that flexibility is true in terms of the rates or the expected returns, as I said, but also all of the other terms that come to play that may be just as important as what the interest or the expected return that our counterparty is looking for.
And so I'll just pick up on that. I think that's a lot of the confusion in the market, and particularly in the congressional oversight part of the political process of TIFIA. And it's, the simple answer is often, well, we're lending at U.S. Treasury rates plus 1 basis point. So you can't beat the rate, but it's the other commercial terms and conditions that kind of mitigate that benefit of a headline rate, and it really compresses the value delta between the alternative you can get in the debt markets and TIFIA. So it's a little more nuanced, and I'm glad to hear that you're not just focused on rate, because I think that's only part of the story.
Absolutely.
Matthew, the EBRD has played an active role in the financing of various infrastructure projects in Europe over the last few years. Can you share with us some of the innovative financing techniques that the EBRD has adopted in conjunction with the private sector?
Sure. Yeah, thank you. I think, one example I'll give is directly from the transport sector, and another actually happens to be social infrastructure, but I think it's applicable to all types of PPPs, including transportation. I mean, the first one I would talk about, it's not usually understood that EBRD, although it was founded to work originally in the early 90s with countries of the former Soviet Union, we've actually shifted over the last 10 years to start to work in Turkey and the Middle East and North Africa. And those are for very good reasons. There's a huge infrastructure gap. So Turkey, in fact, is the country that's probably been the most active with PPPs. The project I'd like to explain to you very briefly is the Eurasia Tunnel PPP. This is for those familiar with Istanbul, you have a European side, as they call it, and an Asian side, and between that is the Bosphorus. So it's an amazing city, but they face that challenge of that water of the Bosphorus between the two halves of the city. So they commenced upon a major PPP. It's about $1.5 billion to build a 4-kilometer tunnel under the Bosphorus, 10 kilometers of connecting road infrastructure. It had a lot of participation from not only EBRD, but the European Investment Bank, Korean ECAs as well. The sponsor that won was a Korean-led with a Turkish and Korean-led consortium. So the innovative part, I think, is what's interesting, as opposed to just doing a straight availability payment approach where all the risk is kept with the public sector. What they did was they bid this out, having said that they will provide a minimum traffic guarantee and a fixed upfront toll. And the toll was $4 equivalent into Turkish lira. So that's 100 million, right, in dollar terms per year. What they did was the bidding criteria was then the bidder that offered the shortest length of operating period of the concession. So you can see how there's competition at the point of entry. I mean, it's quite clever to do that. And of course, they're placing, the bidders are placing faith in the Turkish government and the Minister of Transport to provide that ongoing traffic guarantee over time. What I think was, what was actually most innovative for me was the way they handled foreign exchange risk. Because of course, all of the debt financing came in hard currency, dollar-based in particular, and yet all the revenues are coming from the tolls in Turkish lira. And if anyone has followed Turkey over the last years, this tunnel opened in 2016. It was done before, ahead of schedule, actually. It was a full EPC contract, fixed term as well, fixed budget, finished ahead of time. So off they go, and what happens is there's a 40% devaluation in the Turkish lira versus the dollar in 2018. So major issue. The way they've mitigated this and handled this in the contract was that they stipulated that anything more than a 10% devaluation of the Turkish lira versus the dollar would, within a 6-month period, would be indexed back to the hard currency, and there would be a recalculation and a settlement to effectively cap the downside risk at 10% on a rolling 6-month basis. Because of the volatility of the Turkish lira in the last few years, they've actually gone to quarterly settlements. So, that type of approach where the Turkish state, really, and this is the Treasury, it's passing through budgets to the Minister of Transport, I mean, that really shows quite strong backing for an essential piece of infrastructure. And I think one of the things that I've heard yesterday and today from this conference, and I'm really pleased to be here, it's the first time I'm here at this conference, is there's a lot of concern about how to handle risk and what the public can retain and what the private's willing to do and all the struggles in the market. And I think it really, when it comes down to it, it's just about long-term trust in your public partner. And this is, back to Turkey, to this example, it's been extremely challenging. I mean, to face an environment where there's a 40% devaluation, completely unexpected. But they're withstanding it. I can say the good news on this as a lender is that the traffic is almost up to the 25 million trips level. And so this is it was bid out, the winner was 30 years on the concession. So there's going to be a very significant tail, and that's good news. Good news obviously for the consortium, good news for the banks because we'll get our money back because of all the revenue coming in, good news for the Turkish state because they won't have to be providing the guarantee, and overall, an essential piece of infrastructure, very complicated and was done with a lot of innovation. So I'll stop there and happy to share other examples if we have time.
Andrew, CPPIB is a significant infrastructure investor around the globe and is a firm believer in the concept of public-private partnerships. However, to date, we have had a narrower definition of PPP in Canada, and that's the types of assets available for the private sector to invest in, has also been impacted who those private sector investors are. Do you believe that innovations in financing and funding would allow Canada to broaden such definition of PPP to expand the market? And if so, what are those innovations and how would the market be broadened?
Well, I think this is a great conference and a great forum to share some of the ideas. I mean, at the heart of it, you have a competition for capital across all provinces. We heard from Alberta earlier, all provinces, all countries. And so there are probably a few things that, that policymakers can think about when they're defining their approach to this question, this issue. One of the things that I would say looking at Canada is a lot of the infrastructure is defined here. The P3s are availability based, so they tend to have high levels of debt, low levels of equity. So for some types of investors like us, we are more human constrained than capital constrained. And so we tend to look for equity checks that are 500 plus, 1 billion plus. And so that means the market isn't really open to us in that form. So there are a couple of things that could be done to attract that type of capital. One thing is to create a defined pipeline of projects so that there are a number of projects coming to market. Now, it's not just one, but it's well-defined 10, 20, 30. And then that can bring a lot of talent and capital to the region who are analyzing things for the longer term, and there's a real commitment to it. Another thing that can be done is actually to look quite closely at the risk transfer, and fundamentally, you want to get the risk into the hands of the party who is best able to bear it. And so when there's a lot of greenfield risk, let's say there's a new build, sometimes things like land acquisition should sit with the government rather than the private sector bidder, and that can be a way to make sure those projects get done. But when you look at how certain countries have approached that particular problem, Australia's had a nice model. Australia is called the model asset recycling, where the government will build something, they'll do the greenfield work, they'll then vend it to the private sector owner once it's been de-risked, and then they'll consciously take that money and they'll invest it in new growth projects. So it doesn't go into general revenues, and so the people can see, that the voting people of Australia can see that the sale of the business is going to benefit society. So that can be another tool to attract private capital. And probably the third and most important is the stable, long-term, predictable regulatory regime, generally defined, whether that's how you interface with other parties like TIFIA or the CIB, or rule of law, or legislation, or taxation. All of these kinds of issues go to provide a stable, attractive investment platform for large-scale equity capital.
Great. And just a reminder to people, again, if you've got any questions, please submit them using the app. This is for Mike and Andrew. So Mike, as a global operator, owner, and equity investor of toll roads, Transurban has worked with public authorities to develop and implement unique financing solutions to address challenges with transportation projects. Can you perhaps share with us some examples of transportation projects outlining what the challenges were, how Transurban and the authority came to a resolution, and what was unique about the financing or any other additional benefits? And perhaps, Andrew, you could chime in a bit. I mean, you have done some partnership. The CPPIB has partnered with Transurban on a number of projects where CPPIB has been the investor, and obviously you're taking a unique equity investor perspective versus Transurban that's going beyond just the equity investor perspective.
Yeah, I guess I'll focus on the two most recent financings in the North American business, in the U.S. business specifically, that I've already mentioned, the 395 extension and the Fredericksburg extension of our I-95 Express Lanes project. I think one of the most innovative and maybe surprising things to me is on the 395 project, first of all, it's a long-term concession. That is a 70-plus year concession. So there was some, I don't know if everybody saw the last panel and they were talking about 10 or 20. I mean, we're making, multi-billion-dollar bets for long periods of time, so we need long-term concessions. But the conversation with the state of Virginia on 395 was, could we come up with a commitment to pay to the state an amount of money to be used for transit as a dedicated stream of funding? And we ultimately agreed to pay $15 million per year, escalating at 2.5% through the life of the concession. Okay, you can do the math. That's $2.8 billion. So the state now has a pretty, maybe unique in the country, dedicated source of funding to do everything from buy new buses to park and ride and any other thing that fits in the broad rubric of transit. So that's pretty innovative, and it was only because the credit and the financing structure was able to bear that piece of capital coming out every year. And it's deeply subordinated. It's right before, it's after the debt, but it's before we get paid. So we're all incentivized to make sure that the traffic and revenue hits our forecast. And the second thing that we did on the Fredericksburg Extension project on I-95 Express Lanes was there's a revenue sharing regime that's common to most of these P3 projects, where the state basically makes, as returns improve beyond certain hurdles, more of that money would go to the state above that hurdle. And what we were able to do with the state was negotiate basically to monetize that future uncertain revenue stream and pay it up front. So we basically have made a payment to the state of Virginia of almost $300 million. We're making it in 2 tranches. We just made the first one over the summer when we closed the financing. So again, they were able to take that $300 million and we know they're going to use it to build a bridge. We know that it was also part of the financing incentive package to get Amazon HQ2 in Crystal City in Virginia. So just kind of innovative problem solving around fixing a infrastructure problem and a congestion problem, but unlocking value in a way that we're pretty good at, so that they could do other things on the back of that investment.
Mike, I might borrow the Transurban name for my example then of an innovative solution, although it'll be Transurban Australia. I'm thinking about an example of about 5 years ago where we were a co-investor with Transurban on a toll road in the Sydney area. Transurban owned 50%, we owned 25%, and there was another Australian investor at 25%. And the government had many CapEx aspirations for the region, but number 10 or number 11, never near the top, there was this tunnel they wanted to build, and it was a 9-kilometer tunnel, and it was going to cost about $3 billion. And it never made it into the top 10, so it didn't get done. It had been pushed out a while. And one of the things that we, and Transurban, and we realized is that there was this unique expertise in Transurban to help develop that. And so under the unsolicited proposal mechanism in New South Wales, which I think we heard about this morning vis-a-vis Ontario, Transurban approached the government and said, we'd like to build this tunnel for you. It's going to cost $3 billion. And this is where it got really interesting. The problem is if you toll it, there's not enough traffic. In fact, you can only get about $1 billion of value. So there had to be an honest discussion with the government of what do we do to get the other $2 billion in order for this project to work. And so it was highly innovative because it was highly collaborative. And what ended up happening is 3 things. First of all, since there was a concession nearby that we jointly owned, an old concession, a concession that wasn't with current standards, there were some adjustments that the government could give us, creates value for us, and then we can put it right back into this construction project. And so the 2 things that were done were truck toll rates increased and the concession expanded by another 10 years. That created value to fill the gap. Now, there were a bunch of other things that the private sector suggested to the government, and they said, no, we don't want to do this, we don't want to do that. At the end of the day, they said, but this project is getting really close to being done. Let us put the remaining $800 million in. The city and the Fed, or the state and the Fed both matched a contribution, and they topped it up that way. So we get to $3 billion by having that protected space to have a conversation about here's how we can bring value. What is it that works for you from a policy perspective? So that would be one of my favorite examples on that, Vickie.
Great. Pierre, when people are talking about transportation infrastructure, the conversation usually turns to heavy rail and roads. But perhaps not as many people are thinking about ports, which are obviously critical to the overall transportation network. Can you perhaps tell us a bit about the work that the CIB is doing with the Port of Montreal on its proposed Contrecoeur project?
So Contrecoeur is a small town down the river from Montreal on the south shore. And it is the site for a major expansion of the container terminal capacity in the Port of Montreal. We announced a few months ago that we're working together with the Port Authority to find a creative solution to building significant expansion of capacity. Again, traditionally in Canada, port expansion has happened sort of behind the fence, within the confines of the existing land footprint, using the means of typically going to terminal operators saying, we've got this empty piece of land, it has capacity, please bring some capital, build this thing up and operate it for 20, 30 years, whatever. When you throw into the mix the fact that you have to build new land, basically, to accept this equipment, the economics don't play out as well. And that's where our ability to work together with the Port Authority to inject some of our capital potentially in a formula that allows private capital to come in, but most importantly, that allows a project to go forward when the economics are not sufficient for a pure private solution to take place. That's when we can be really effective, and that's what we're working on and continue to work on with the Montreal Port Authority and Contrecoeur. Great.
Matthew, you alluded to this earlier, but it's my understanding that the EBRD has used some innovative risk transfer mechanisms that enhance the financing for certain hospital projects. Perhaps you could walk through some of these innovations for us, because, I mean, quite honestly, a lot of these things could potentially be applied to transportation projects, and we need to learn from one asset class to another.
Okay, great. Yeah, happy to do that. Well, I'm going to stick with Turkey, because this is where this product was tested and successfully rolled out. So Turkey, in addition to a lot of transportation projects, they embarked about 5-6 years ago on a major hospital PPP program. 30 hospitals are to be built. 18 of them have been awarded. Another 12 coming. 10 of them have reached financial close, and I think 4 have opened. Now, in the process of sort of coming through the first 7 or 8 of them, they were all long-term debt financed, including by EBRD, the European Investment Bank, and the IFC, et cetera, and a lot of commercial banks along the way. About 11 billion in investment. Hospital number 8 was in a place called Elazığ in central Anatolia. 300 million capex, greenfield hospital. And the sponsor who won that looked around at sort of the banking market and realized, you know, there's been 11 billion in debt financing, and if there's another, whatever, 20 of these to come, maybe we need to think about some innovation, how to go to the capital markets for this project rather than long-term debt. So we all sort of sat down and put our heads together with this sponsor, which was Meridium, if anyone knows Meridium as a fund. Very innovative by nature, a lot of risk appetite. They had a local consortium member, Renaissance, who's one of the leading Turkish construction companies. Now, what they did is they sat down with them and they said, we want to go to the capital markets, but the sovereign rating of Turkey is 2 notches below investment grade. And if we want to go to the capital markets and we want to, what we're trying to tap is the institutional money in Europe and globally, it's not going to happen with a project that would be, for all intents and purposes, you know, rated at the same level as the sovereign. That's the norm, as you all know. So what we did was, instead of sort of being our typical mode of providing long-term debt financing, we developed a product with them that essentially says, okay, we need to de-risk this project in some way. Where are the real risks? And one of the first risks, which we all know about, is during the construction phase. So we set up a facility that is a standby liquidity facility. Essentially, a big pot of money. It was 88 million compared to the 300 million capex. Half of that 88 million is available as a sub-facility during the construction phase, and the second half is during the operational phase. So, you know, sort of 3-4 years period for the construction and the next 22 years during operations. What this did was essentially say, we have faith, this is EBRD speaking to the sponsor, that you know what you're doing, you're highly qualified. We had, by the way, they had been a borrower of ours 3 times previously in this market, so we knew them very, very well, had a lot of trust in them, which is key to doing this kind of thing, of course. We said, listen, if you run into a problem in the construction phase, let's say the Ministry of Health comes along and has a problem with the way you built X part of the hospital, you enter into a dispute, you go into the international dispute resolution process, which, you know, takes 3 to 4 years to wind its way through before an arbitral award will be given and before any money from any kind of guarantee would be awarded. What we said was, we'll disperse straight away. Within 60 days, we'll provide you with the liquidity that you need without any further discussion, effectively, and you can then make your timely payments to your bondholders. Now, that was a really different way of looking at things, and Moody's, when Moody's was rating this project, this PPP, they had been following this whole process. They looked at that and they said, with that kind of commitment during the construction phase as well as during the operational phase, again, disputes come up there as well over KPIs, et cetera, especially with things like hospitals, which are complex, as we know. They looked at it and said, we're going to rate this project 2 notches above the sovereign rating. So we pierced the sovereign ceiling. That was enough to get to investment grade. And that then unlocked a lot of interest in that bond issuance that was done in Luxembourg. It's a lot of detail, but the point is that it was oversubscribed by 3 times. In came the bond, the capital markets investments from institutional investors, and off we went. I think the postscript to this is, one, the project got completed again on time, a little bit before time. So that part of what we were holding was unwound, and that part of the facility is done and dusted. The second is that Turkey, because of its difficulties over the last 3 years economically, they've been downgraded 3 subsequent notches by Moody's. It's now 5 notches below investment grade. The project, however, has been maintained at the same rating. So now the project is five notches above investment grade, which really, for all of you who understand, this kind of thing, I mean, this is really, it widens, and now I'll broaden it to infrastructure more generally and to transportation and so on. I mean, if you can do that there in a country that has gone through what it's gone through, if you can get projects around the world that are 5 notches below investment grade, provide that kind of support, it just opens up a lot of things that you wouldn't be able to do with the capital markets. And I guess the importance at the end of the day for this kind of thing is this is where the big money is. That's the wall of money in the tens of trillions that's available globally that is seeking a place to go for higher yield. And I think we are actively trying to get this replicated, not just for ourselves, but we're sort of proselytizing to every other development bank, anyone else who has sort of a AAA credit rating out there. People could do this kind of thing. I would think it might be interesting for a country like Canada to look into. We'd be happy to share all of the documentation. Again, we're a public institution. We'd love to see this replicated. So that's my little story on sort of risk mitigation with a standby facility. So.
Great, and maybe we'll turn now to some of the questions that have come from the audience. Pierre, looks like this first one's probably for you. Is how can CIB demonstrate a depoliticized approach to credit decisions? Are there any learnings from the experience of CPPIB or others?
So CPPIB and we are both Crown corporations, but our respective enabling legislation is actually quite different. But we do share a few things in common, and one really important one is that we have each a board of directors that's comprised of people who are selected for their competence rather than their political connections. And I've lived it over there, and I've lived it here now for close to 18 months. And having that group of directors who ultimately for us are the ones who approve the investments. To have them be credible business people who are challenging in that sense to deal with from the management standpoint, but nonetheless are really performing their function. And I think for people to look to that as a key indicator of how we run our business, I think is really important. And I think the more investments we put out where people can look at the investment and say, that makes sense, that adds value versus traditional model, like I described in REM earlier. That brings a new project to life that otherwise might be stuck in that, as Andrew described it, priority number 11 on the top 10 list forever. If we're able to demonstrate that day in, day out, then I think people will realize that while, of course, our investments have to be made in the public interest, which means that our investments have to align with the relevant levels of government's policies and priorities. That's important to us. And frankly, it's important to our board, but it's also important to our shareholder. And it's important to remember at all levels, not just the federal government agenda, but really 90% of the infrastructure is owned by municipalities and provinces. They have to be in line if anything's going to happen. They have to be supportive. That's how I think that's how we manage it.
And I think this is an open question for the panel, but how do you feel about incentivizing Indigenous investment in infrastructure, particularly in projects that benefit their communities?
I can take a crack if you want. Anybody else want to tackle that? Sure, leave it to me. We think of Indigenous communities for us in this FPTMI string, federal, provincial, territorial, municipal, and Indigenous communities are all partners that we can work with. And there are, across the country, there are gaps in the infrastructure. It varies a little bit province by province or territory or municipality or community by community. As I just said, it's important for us to fit within the priorities of the communities. And in that sense, we are wide open to engaging and have actively been engaging with Indigenous communities, as well as investors that have a particular mandate to promote investment in Indigenous communities, to find areas where we can be active and deploy capital in the same way that we are with municipalities, provinces, territories across the country.
Oh, I see this one will be a good one. Canadians have traditionally been averse to tolling. What could move that opinion to help bring other revenue tools to much-needed transportation infrastructure?
I'll take it.
Andrew,
Not
Mike,
Canadian,
it's one
but
of
I
the two of
guess
you.
it applies to, it's a global phenomenon. Nobody raises their hand and says we love tolling. But the reality is it is a way to have users pay for infrastructure, right? And rather than having a broad-based tax increase to finance, massive infrastructure needs, just in Quebec, if you just go around and see the cranes and construction everywhere, I mean, that's being funded with broadly based taxes, right? The alternative is if it's specific to fixing a congestion problem. We think the model that we have in Virginia, this is something that's different from how Transurban works in Australia and in Virginia. Again, the Express Lanes project is really not just a toll road, it's also a transit solution, because these are under our concession agreement we've negotiated with the state. HOV 3, so 3 or more people in a car, drive for free. Buses drive for free. Everybody else pays a toll. So we're providing free-flowing transit options at a much increased pace. The alternative right now on the free roads in Virginia are, if you're in a bus, you're sitting in traffic. So it's sort of the worst of both worlds. So we're trying to bring that concept more broadly in the U.S., and we think it will ultimately have some success in Quebec and elsewhere in Canada. But we know it's a long road, and we have to demonstrate that we're here for the long term, and here's how we mutually could solve these problems.
Maybe to add on that, not speaking as an investor, but just thinking about some of the policy issues around it and some of the social issues, it strikes me that one of the forms of revenue that governments rely on is a gas tax. And as people move to electric vehicles, the gas tax will decrease. So there have to be ways of replacing the construction or maintenance of many of the things that Mike talked about. So I think that's something that will change as technology changes. And the second thing I was going to offer is, I don't know how many people in the audience own a car, but then when you reflect on a generation maybe a little bit younger, how many of those people own cars these days? I see more and more people thinking about mobility as something you rent. I'll rent an Uber, I'll rent a Lyft, or whatever the next generation tool will be. I think there is a generation coming that's used to pay to play rather than to put a lot of money aside into something large like a vehicle, and I think something like tolling or user-based charges is perhaps illustrative of that generational change.
I'll just give an example that I had the really good fortune to see 3 weeks ago in Taipei. What they did there, and I think this is again something that I think a lot of jurisdictions around the world are going to do in the next years. They started off with a traditional tolling system. They had about 1,000 miles of traditional tolls with gates, et cetera, the sort of hard infrastructure. it generates revenue, but it also creates congestion at certain levels, and it's not a great sort of solution from that standpoint. So what they did was they progressively over a 5-year period, again through a PPP, 20-year PPP, they tendered out an electronic toll collection system, an ETC, now with a company called FETC. Now this is really tremendous because it's per mile based, so it's distance-based tolling. It's variable dynamic tolling by time of day, so you can do kind of congestion management. But probably the most, the best thing about it is it's fully free flow, multi-lane free flow, all classes of vehicles, 200,000 vehicles a day on a road. I mean, this is, when you see it live, and as sort of a transport geek, this is really amazing stuff. It's been up and running for 4 years now. Quick numbers, $200 million in CapEx, and the annual revenue, and it was bid out on the basis of the percentage that needs to be retained by this PPP operator. Lowest level of retention wins. The winning bid by this FETC was 7% of all revenue. 93% is passed to the government, which they use to improve infrastructure, including public transport, metros, et cetera, but also roads. So 200 million CapEx, $700 million in annual revenue for 20 years, and so this is just tremendous amount. And what they've been able to do is, they can actually reduce the taxes at the pump, of course, because they're collecting all this other revenue. So they're protected against all this transition, which is going to come through electric vehicles and the shared economy, et cetera, et cetera. So I really, I go around our region in Eastern Europe and beyond, and I'm advocating for this kind of thing. ETC, distance-based, variable tolling. I think that's the future of tolling.
Can I just make one last point on the dynamic toll, which is how we run our express lanes in Virginia? So there's no cap stipulated in the concession agreement, which is surprising to some people, but we have to have that flexibility to be able to basically drive you off the road, right? We're trying to raise the toll so that we have the optimal free flow of traffic, so that you're getting the benefit of the bargain that you're paying for. You're paying a toll, we're gonna get you 65 miles an hour, free flow traffic. We have to have that flexibility. And I think what's, again, a little paradoxical to me is when we survey our customers, and the people who are usually most satisfied are the people who pay 20, 25 bucks. Because the way the geography is in Virginia, the free road is right there, and the express lane is right in the median. So you're going 65 miles an hour and looking at a parking lot, and you might be paying 25 bucks, but you're pretty satisfied because you're saving 30, 40, 50 minutes. And that's so it takes a while to change, I think, minds and behavior, but we're in our 5th or 6th year now, and it's starting to show up in the results of these surveys that we're doing with customers.
Okay, well, I think we're out of time here. Maybe I'll just ask each of our panelists to close out with a parting thought and maybe what they'd like to see the Canadian infrastructure market adopt to permit more innovative financings. Perhaps, Mike, we'll start with you and work down the line.
We're just very excited to have CIB here as a potential partner. We made a big bet on Quebec. It's really only our 3rd country that we've expanded the Transurban business into, and we don't do that lightly. It's because we don't just like the bridge and road that we bought in Montreal. We're making a long-term bet on the right policy and financial environment to be here for the long term. So we're really happy to see CIB and others supporting this conference and the industry that we're trying to spread.
Yeah, my quick thought is I've learned a tremendous amount just in 2 days here, and I realized that Canada has a lot to share with the rest of the world in terms of infrastructure delivery and P3, your P3 model. So I'm all for sharing lessons learned. I think you have a lot to contribute, and I'm open to interacting with all of you who are interested in doing things in emerging markets with us. So happy to be here. Thank you.
The risk of repeating what Matthew just said, every country in the world seems to articulate an infrastructure gap, and every investor in the world seems to talk about, we wish there was more to invest in. So it's great to be able to meet with many of you and hope we can pair those things up. CPPIB would love to have more investment opportunities.
And we're going to make some of those come together for you. And my parting thought is that as Andrew just described that gap, everybody realizes, as I've gone from coast to coast to coast, speaking to public sponsors at every level of government, that traditional methods of financing and the traditional, availability of traditional funding formulas and so on is limited, and it's limited far short of what they and their citizens want to see happen, and far short of providing appropriate customer user experience in the various, whether it's urban transit, whether it's roads, and they are remarkably open-minded across, and Aaron earlier said this isn't a partisan thing, and I think that's true in this case, across all political parties across the country. There is this realization that we can do things differently to get more done more quickly, and there's a tremendous amount of potential and momentum behind that idea. So there'll be lots for us to do together, I'm sure.
We, of course, have the money, so we're all set with that to do this all. Gentlemen, thank you very much. We appreciate you doing the last panel of the day. You are all now released to go to the bar. Thank you.
Thank you all.